Hello, this is Mohammad Raza Islam. We are three group members, me, myself, Mohammad Raza Islam, Alamin, and Carlos Jutens. We have two case studies that we are going to be explained further for fair value accounting and inventory recognition. Let's move on further. So before moving on our case studies, we should know what is the fair value accounting. Fair value accounting is an accounting approach in which assets and liabilities are measured and reported at their current market value and at the current market value rather than their historical cost. The method is aims to provide a more accurate and timely picture of a company's financial situation by reflecting current market conditions. So there are different conditions and there are different tools to how to measure the fair value accounting. So after that we have an inventory recognition. So what is inventory recognition? Inventory recognition refers to the process by which a company identifies records, controls, and the measure the values of its inventory in its financial statement. The process is very crucial um, uh, because determining the cost of goods sold and the value of inventory on hand at any given point in its time. So there are the different definitions that we have described. Inventory includes goods that a company holds for a sale in an ordinary course of business, as well as raw materials, work in progress, and finished goods. There are different raw materials, work in progress, finished goods, and these are the types of inventory recognition. So after that we have a fair value. So fair value is refers to the process determining the cost and the price at which an asset could be sold or a liability could be settled in orderly transactions between market participants and the measurement date. The process aimed to providing a more accurate and timely reflection of current market conditions in financial statements. So at the end, we have a inventory. What is inventory? Inventory consists of goods held for sale in the ordinary courses of businesses, as well as raw materials, work in progress, and the finished goods intended for production and sales. The next one is the introduction to fair value accounting as a SFAS 157. As I already described, what is the fair value, and we requires the market-based measurements applies to a range of assets and liabilities. We have some complexity and cost implications, like its estimate exit price involves significant assumptions and market data. It also requires extensive resources and specialized experts. We have need high implementation compliance costs of companies. Sometimes we need different types of difficulties, and we need some different things like managing operations cost. We have operational cost, we have applying fair measurement to a non-financial assets. We need risk manipulation, we need a high cost of stakeholders, like including companies, investors, and that can be from auditor side. So that can be reflect on a market value. So um, uh, I already talk about the complexity and fair value accounting very briefly. So, if I explain the fair value estimation, involves this involves determining the exit price in an orderly transactions, utilizing market participant assumptions, requires use of observable market inputs and unobservable inputs that are necessary. We have some challenges and resource requirements. That is, we are facing difficulty in obtaining reliable market data for unique or specialized assets. We need frequent evaluation to reflect how the market is going on. We have a significant time and effort from financial professionals. We need high cost for hiring valuation experts and implementation necessary items. We also increased audit and compliance burdens, that is ultimately affecting on the complexity. And So, in applicability issues stipulates certain circumstances where the fair value circumstances should be used, such as business combinations, special purpose machines. Benson's claims that the implementation of fair market accounting entails a lot of difficulties when dealing with you can say with such a line of businesses. The standards entail a requirement for measuring liquid assets that are not usually transacted within the market, which poses difficulties in determining both the bidding and the exit price. This can cause a problem for the standard, as it is difficult to apply it consistently across different types of assets and transactions, that is the financial transactions, instrument, and investment properties. So these are the difficulties that I already talked about. So at the end, we have a potential or zero negative value. So what is the negative value and a zero potential for zero? So stating an importance consideration about the possibility for the effective values being close to or lower than zero under SFAS 157. This is a very common problem with specialized assets like custom-made machinery, except for the ones who currently own them. Valuation of possible deals might render reported balance sheets and income statements less relevant for ongoing businesses. So this will also distort financial analysis and discourage appropriate decision making. So these are the some highlights, key points. The specialized assets like custom made machinery, fair value may be close to lower than zero, or these unique assets, difficulty in finding comparable market transactions. So I would like to invite Alamin to describe further. Thank you so much.
Thank you, Mohammad Raja Islam, for continuing with the case and giving me a chance to get back to this case. And thank you, Professor, for giving me a chance to make some presentation and make some good vibe on this case. I'm going to continue from the manipulation risk about this case. In manipulation risk, we can divide it into two major factors: risk of manipulation in fair value accounting and the implications for financial statement reliability. In here, in risk of manipulation, fair value based on subjective assumptions and estimation potential for delivery, showing the valuation to meet financial targets. And implication for financial statement reliability, reduce trust and confidence among investor and stakeholders. However, one of the major risks associated with fair value accounting is the manipulation risk, has been highlighted by Benson. Fair values can be based on various assumptions and estimation amount about future market condition and potential buyers, which can make them deliberately short and skewed. This explicit provision may raise to the question about the reliability of the financial statement, and therefore it will be problematic for investors and auditors to trust the reported figures. The next one is high costs for stakeholders. The high cost for stakeholders, we can categorize this section into two sections: cost for companies, investors, and auditors, and challenges in understanding and interpreting valuations. If we want to talk about the high cost for a stakeholder, including companies, investors, and auditors, this definitely comes through the application of SFAS 157 is bound to strengthen the financial picture of every concerned party, including companies, investors, and auditors. And as a public accountant, these stakeholders have to bear the cost of complicated valuation process and the auditing process to make sure that these valuations are accurate. The striving to understanding this value is the obstacle in the path of investor and accountants, as they may not always be able to interpret them correctly, which may in turn present a misleading and wrong picture of the financial health for the company in a longer version of period. And this is a very risk for misinterpreting, leading to incorrect financial analysis and decision making as well. And file in this process, we can talk about applicability to ASSB 13, IFRS 13. In this major part, we can compromise it in three different parts: comparison of SFS 157 with SSB 13, similarities in this complexity, cost issue, and need for reassessment of the fair value standards. SSB 13, IFRS 13, which also require fair value measurements, are also among the ones that Benson criticizes. The same rules applies to the valuation for assets, liabilities and are therefore often complicated by their factors by complexity and high implementation costs. The applicable of zero or negative values and the weak point of the manipulation are quite the same as the broad difficulties in appraisal for the fair value accounting standards. And in the different legal frameworks, this implies that there is a worldwide necessity to reassess how the just of both calculated and utilized in financial reported to the overcome this problem. And these potential revisions of the enhanced reliability and comparability in financial reassemble is very major in this case. And at the end, we can conclude these things with a very major and highlighted quotation from a good author, William and Mary. And they stated that the SEC and FSSB have developed a number of complex accounting standards to address the needs of investors. The fair value standards are a part of this. Fair value accounting is consistent with this concept and is basis of the accounting for financial instrument that reflects the economic reliability of today. Accounting has to meet these critical challenges in real world, and fair value accounting is one of the examples of where the FASB and SEC have provided the mechanism to do exactly this minimization. Now, this is time to get into the case part B, and that is a critical one where we're gonna develop our case study in a very details with the mathematics and those measurements where we can do to be deep into that side. Before we deep into that side, I want to make a very good introduction and the overview and the key points from the case. As an introduction, this is an auditing company named Wellington Limited, and this company is focusing inventory recognition of as of 30 June 2025. So if we go through the case, the main thing about the case is Auditing Wellington Limited, a company that underlies perpetual inventory system. And I have come across a rather than the accounting of the inventory as of 30 June 2025. In the process of audit, it was observed that there is a shipping container near the main warehouse containing goods for sale. Container FOB to Melbourne that sales on June 24th of 2025 should not be included in the inventory as of the closing date of June 30, 2025. And due to this, container will not constituted is the inventory items due to the invoices attested to this goods amounting to 50,000 as an additional 16,000 as freight cost and not being paid until mid-July. And this was the main introduction of the company and the key points. Now I would like to invite my friend Carlos to make a clear case study about this presentation. Thank you, sir.
So I am here to discuss the analysis of liability on 30th of June 2025. So the shipping term FOB place means that the ownership of the goods moves from the seller to the buyer at the point of dispatch of the goods. So this means that the seller has fulfilled its obligation when the goods are loaded on the vessel nominated by the buyer at the named port of shipment, which in this case is Melbourne. So the seller should be the one loading the goods on the vessel, while the buyer is responsible for everything else necessary to get the goods to the final destination. So that's pretty much what FOB means, and transfership of owner's significance even though the control of goods has been transferred on 24th of June, inventory should be recognized and the ownership is transferred regardless of when the buyer wants to pay. So this means that financial reporting would be accurate and recognition of liability should be done on the 30th of June. So our journal entries is here: debit inventory and credit accounts payable. Why do this entry? Because it reflects acquisition of inventory now owned by Wellington. Recognize the corresponding liability for the goods shipped, FOB Melbourne. Ensures accurate representation of inventory and liabilities of 30th of June, and it complies with the accounting principles regarding ownership, transfer, and inventory. So, in the inclusion of goods in the inventory balance, we think that they should be included. It is necessary to present the company's assets through and fair view and to show its financial position at the end of the fiscal year. Although the accountant initially refused to include these goods in the inventory, as they were not going to be fully paid until later, this does not follow the generally accepted accounting principles that once the control over the inventory has been obtained, inventory needs to be recognized. As stated for the inclusion of goods, the control was established by 24th of June. So we recognize inventory based on control, not based on when it is paid. So representing the true and fair view, it is an accurate reflection of the company's assets. It ensures the financial statements are reliable and able to comply with accounting standards. And it provides stakeholders with clear and honest view of the company's financial position. So to do the journal entry, should should debit inventory and credit accounts payable. This ensures that the inventory balance will include goods owned by Wellington Limited as of 30th of June 2025. It accurately reflects the acquisition and corresponding liability. It aligns with the generally accepted accounting principles for inventory recognition, and it corrects the initial omission to present a true and fair view of financial statements. Next, but even so, yeah, but even so, as an auditor, need to have a recommendation to the supervisor based on the audit findings. So it is critical that these findings are communicated with audit supervisor and underline that even though the payment could be deferred, the full amount of liabilities and assets cannot be deferred at the same time. The goods in the shipping container are within the criteria for inclusion in the inventory count as of 30th of June, based on the ownership and control criteria that were established by the FOB Melbourne terms. Failing to account for these items in the inventory leads to inaccurate inventory valuation. This balances bringing about the statement's validity. So, as stated in the importance of valuation, this really critical for informed decision making by stakeholders, and it does reduce the risk of financial misstatements and regulatory issues down the line. So for our final recommendations, there needs to be communication with the audit supervisor, which is to discuss audit findings and necessary corrections. Highlight the importance of including the shipping container goods in the inventory. In order to correct the financial statements, adjust inventory and accounts payable balances, and to ensure all owned goods are accurately reflected in financial reports. If there's anything to improve in accounting procedures, review and update inventory recognition policies. Implement training for accounting staff on FOB turns and inventory counting. And there is a need to establish regular audits to prevent any future discrepancies that would that would lead to problems when trying to do the accounting statement at the end of the fiscal year. And the last would be, if there are any references or questions, you may be able, if you want to ask any questions about this. So any question, please.